Welcome everyone to New Energy Updates webinar. We are doing this in partnership with BP, US Gain, AMP Americas, and Waste Management Renewable Energy. I'm Diana Droppel. I'm going to be your host for today's webinar. And before we start, I'd like to tell you a few words about New Energy Update and the purpose of this webinar, because I imagine some of you might not be familiar with what we do. So I'll give you a few words. So New Energy Update, we are an organization that helps renewable energy executives to try to anticipate the future, right? So, try to formulate plans. Obviously, the industry is going through constant change. This means a lot of things. So we try to figure out how to do things through a lot of independent market research. And specifically in the biogas and renewable natural gas space, we deliver webinars, we deliver reports, white papers, and all of this stuff is really meant to provide you guys with valuable content, right, that you can then use to stay ahead of the changes that happen. Hopefully, to have a direct impact on biogas to renewable natural gas production and everything regarding its utilization cycle. So we put together this webinar today to look at how to monetize renewable natural gas production for vehicle fuel. Big words, big, really important words. And obviously, we're always looking for collaborators. So if this is something that you feel you could contribute to, then reach out to me after the webinar or whenever you feel like it. We're always ready to start a conversation. So topically, we are here. We believe that the highest value for renewable natural gas is in the vehicle fuel market. But we also know that for you guys to truly monetize the environmental attributes of your biogas production, you need to overcome the limitations, to access those pockets of money that will move the market forward. And fortunately, there are ways to do this, as the webinar will explain. So we are really, really excited. We're partnering today with Nick Lumpkin, who is the strategic originator for environmental products for BP. Andy Dvorak, who is the Vice President for Business Development for AMP Americas. Mike Cole, the President of US Gain, and Ryan Gack, who is Manager of Biogas Marketing for Waste Management Renewable Energy. So really, really, really good people here to talk about, all the stuff that they've learned in the field. They will be covering a few things, and obviously your questions can come in at any time. So we're planning to talk about vehicle conversion costs, also the monetary incentives that are available, whether they can be factored in to predict profitability. Also, very important aspect, the process to accelerate the transition from a diesel fleet to renewable natural gas. And also the potential reasons why you would actually transition to renewable natural gas if your providers have solutions in multiple markets. Some clarity on the existing number of natural gas vehicles on the road that can actually be fueled by renewable natural gas today. And also, what are the actual natural gas vehicle players? What are they doing to increase the number of vehicle conversions? So from diesel engines to natural gas engines that are actually fueled by renewable natural gas. So a lot of exciting stuff, a lot of good things. As I mentioned, remember you can send in your questions at any time for the Q&A. If you have any technical issues, just drop me, the organizer on the platform, a message directly. These recordings will be sent via email to you. So if you cannot, stay tuned in for the whole session, don't worry, you'll receive the recordings. And yeah, thank you to everybody in advance. I hope you enjoy it. And I'm going to hand you into Andy to take us away.
Okay, Diana, I'm ready to start, but I need the notice to share my screen.
Yes, it's coming up right away. Just 2 seconds.
Okay. Diana, can you see my screen?
Yes, I can see your screen.
Okay. So, my name is Andy Dvorak. As Diana said, I'm the Vice President of Business Development for AMP Americas. Just a little bit of background on myself. I'm a developer, been in the business for a long time, originally cut my teeth developing projects through the Kyoto Protocol for a number of entities when it was in existence. The U.S. was not a party to that, but we had projects in Southeast Asia and Africa and other parts of Central and South America bringing carbon offsets into the market under the UN-backed Kyoto system. Just to give you a little bit of background on AMP Americas, we're a vertically integrated company. We work on all sides of the value chain. We manage and build projects that produce renewable natural gas. We have relationships into fleets and stations for the dispensing of that natural gas into large vehicles to then help monetize RINs and LCFS credits. And then we have a business where we help generate the revenues from those credits by marketing the RINs and LCFS for projects that we develop, as well as third-party projects. We're an owner-operator, investor in projects. We have a particular interest in the dairy sector, but we also work with landfills and wastewater treatment facilities. Just a small amount of tidbits on the company. We at one point owned and operated 20 CNG stations, predominantly in the Midwest, Southeast, and Texas. We recently sold those stations. We continue to have relationships back to those stations. And then we own and operate 3 existing dairy RNG projects that produce gas into the California market. These are the first projects able to bring dairy RNG into the California market and monetize those environmental attributes. And then, like I said, we run a business where we can help third-party entities that invest in their own projects to bring that gas into our relationships and our station relationships into California and other parts of the country to help monetize both RINs and LCFS credits. The RINs under the Renewable Fuel Standard and the LCFS credits under the California Low Carbon Fuel Standard. So the last picture here is just a couple shots of our projects. The bottom right is our first project in Indiana. It began operation in 2011. We produce gas that goes into the California market. Project on the bottom left is our new project that became operational at the third quarter of last year. It's about 25% larger than the first. And then the picture in the top is a gentleman filling at one of our stations. That's an actual driver and not an actor. It's one of my favorite pictures. So that's a little tidbit on who AMP Americas is and who I am.
Andy, so sorry to interrupt. It's Diana. Are you able to reload the PowerPoint on your screen?
Did it not come up? No. All right. Hang on one second.
Yeah. So. Oh, great. Right. It's up. Yeah, it's up right now. Thank you very much. Apologies again. Thank you. Continue.
Sorry, guys. Here's the first shot that you saw. The second shot, which is a little tidbits on who we are. The statistics I threw at you, and then the last one is the picture that I mentioned. All right, Diana.
Right. Thank you very much. Right. Okay, we're going to move on to Mike's introduction.
Good morning. Thank you, Diana. I would really welcome the opportunity to be a part of this. A little bit about myself. I have 27 years of experience in both natural gas and renewables, and bring that to this wonderful team that we have at US Gain. US Gain is a leader in development, procurement, distribution of renewable and compressed natural gas in the transportation and energy markets. Today we have over 20 renewable natural gas development projects that we're part of. We have 55 CNG stations, both public and private. We also have 60 delivery spots that we go with renewable natural gas in addition to our own CNG sites. we've diversified, and as Andy said, I think one of the big words is integration. One thing about US Gain is part of a 2,200 employee company, US Venture. With that comes a lot of resources that are able to really boost our 25 people that we have. And what sets us apart is that we have our own trading desk. We have a compliance team. We've been in renewables since their inception. So we've been doing ethanol and biodiesel since 2007 with the inception of the RFS. We have our own risk management system. We make investments in projects, but we also own our own dispensing. So we bring that all together and bring that expertise to both partners that are on the upside, being the developers, and on the downside, downstream being Fortune 50, 500 type companies, school districts, and waste haulers. You can see from the map that we have displayed, we are really kind of across the majority of the lower 48 states, and that's our footprint. And hopefully today we can come out and answer some questions for folks that are looking to get into both CNG and RNG, either downstream or upstream. Thank you.
Wonderful. Thank you very much, Mike. Next panelist is Ryan.
Hi, good morning, everyone. My name is Ryan Gash, and I am the Manager of Biogas Marketing at Waste Management at our headquarters in Houston, Texas. So I am going to get my presentation up. So Waste Management is the leading provider of comprehensive waste management services in North America. So we hold a unique, fully integrated view that is unrivaled in our industry, and I'll explain that in a minute. But our asset portfolio spans across all components of biogas and renewable natural gas. In that we own the landfills, we own the renewable natural gas facilities that we build on our landfills, we own the compressed and liquefied natural gas fueling stations that our truck fleet fuels with. We also have landfill gas to electricity facilities, and we also have over 8,400 natural gas vehicles in North America, which is the largest heavy-duty truck fleet in the continent. So we have 137 natural gas fueling stations, again, that we own and operate. And we also have a power business too, so we have a landfill gas to electricity.
Wonderful, thank you very much. And
one more.
Lastly, we have Nick.
Okay.
Oh, you're not done. Sorry, apologies.
Yeah, no, that's all right. I just wanted to display a map of where our CNG and LNG truck
Oh yes,
fleet
sure,
is.
please do.
We have invested $2.5 billion in our truck fleet, $300 million in our fueling stations, and our future investment may total up to about $5 billion across a future count of about 16,000 compressed natural gas and liquefied natural gas trucks by the late 2020s. Also, by potentially 2025, we may run about 80% of that fleet on RNG, most of which would be developed from our own renewable natural gas facilities. And then finally, our fueling station investment would total about $600 million. So quite a substantial sum of investment dollars here for Waste Management and the Renewable Energy Group, which I am a part of. And Diana, that is the end of my deck.
Wonderful. Thank you, Ryan. Thank you very much. The last introduction is Nick Lumpkin.
Yeah, hi everyone. I won't be sharing slides today, so I'll just give you a quick introduction, and then we can move on to what should be an enlightening conversation, I hope, for everyone. Again, my name is Nick Monken, and can you hear me all right, Diana? I'm assuming yes. So I have an origination role in VP's Environmental Products Group. My focus is in the biogas business, really specifically I've been in the biogas business now for about 10 years. Started over at Clean Energy and helped start their renewables group, where we got involved early in landfill gas projects, and we're the first to get a project registered under EPA that did pipeline injection. I believe Waste Management's Altamont site was the first site that participated under RFS. That was a landfill. I came across the BP about 2.5 years ago as part of an asset purchase. So I worked with Ryan. He didn't know it, but Ryan was at BP for a while, and I met and worked with him for a little bit before he started at Waste. As far as BP's role in the space, it starts really from a natural gas trading standpoint. BP is one of the largest, if not the largest, market participant for North American natural gas, and we move a lot of product all over Canada and the U.S. as far as biogas is related. That's helpful. BP is also an obligated party under both the renewable fuel standard and the low carbon fuel standard, which are the markets where most of the value can be gained if you're an RNG producer. BP is an RNG producer as well. We have a JV with Aria Energy and continue to develop RNG facilities, notably landfill gas, but we are looking at wastewater treatment and AD facilities alike. And in addition to that, I'll mention that BP has a joint marketing agreement with Clean Energy and Clean Energy Renewables, where BP is focused on securing supply and Clean Energy is more focused on the downstream development and demand growth. But that doesn't prevent either group from signing up both supply and demand. The best way to reach me, if at the end of the call you'd like to, is via email, and it's nicholas.lumpkin@bp.com. So first.last@bp.com. And that concludes my introduction. I'm looking forward to fielding some questions.
That's great. Thank you very much, Nick. Thank you, everyone. Thanks very much for providing these introductions. And now I propose to go through a few questions, since this is a panel discussion, and I'd like to hear your thoughts on a few things. So I'll start with a question for you, Andy, but then you can all, obviously respond to the same if you would like to respond. So California, we hear a lot about California, being the predominant market for renewable natural gas. But lately also, we hear a lot of things about the fact that it's almost fully saturated with renewable natural gas. So Andy, I'd like to ask you to start with, how do you plan to participate in this market when there are actually limited buyers for the increased volume of gas trying to get into the state?
Yeah, it's a good question. The RFS program on a national level, administered through the EPA, has created incentive for the use of renewable natural gas in the compressed natural gas space across the U.S. California has created a separate program under the Air Resources Board called the Low Carbon Fuel Standard. And what that basically does is at a state level, they ask for additional abilities to address renewable energy in their addressing carbon in particular. And so a project that delivers renewable natural gas into California can generate both RINs under the RFS program as well as generate LCFS credits under the Low Carbon Fuel Standard program. And so your gas is more valuable in the California market than it is in the domestic market, excluding California. And so there's been a land rush to California. That's been predominantly led by landfills who have filled that market to a large extent. And the renewable natural gas business has been growing at a 35% clip, whereas the compressed natural gas utilization in trucks has been growing at more of a 5% clip. So the net effect of that is California is largely full of gas, renewable natural gas at its stations, and across the United States, there's still a lot more room to grow. But what has happened is projects are categorized and scored based on carbon intensity score administered through the ARB. And certain projects have scores that are higher or lower than others. Landfill, which is the predominant RNG gas, tends to have a score in the 40s gigajoule, or on a scoring basis. I won't get into the details. I want to keep this high level. But a wastewater treatment plant tends to be slightly lower than that, probably in the 20s. And anaerobic digestion, the place that we particularly work, is in the negatives. And so on a per decatherm basis, we can produce a lot more credits than the other projects, but our volumes tend to be a lot smaller. And so what we're seeing happen at this moment in time is places that are dispensing landfill gas are looking to swap out landfill gas for much lower CI gas as it comes in. And that's where our marketing business plays, in that swappability and moving landfill gas currently dispensed in California out of California into the larger United States, while bringing in low and ultra low CI gas into the California market. So we're starting to see the markets materialize, and all the folks on the phone play in that in various capacities. And that will be increasingly important because we need more room in California. We need more demand, which is extremely important for our business.
That's great. Thank you. Thank you very much. Related to what you just said, and again, I'd like to actually address this question to all the panelists. How do you think that the recent demand that we see in Oregon or Washington State or British Columbia, how does it affect renewable natural gas markets? Would anybody like
Diana,
to start?
This is Ryan at Waste Management. I can lead with that. So we have a truck fleet, several in Oregon, and an even larger presence in Washington State. So as the low carbon fuel program, or as they call it in Oregon, the clean fuel program, was implemented several years ago, we then began filling that state's fleet with renewable natural gas from our landfill facilities. And then in anticipation of an upcoming or regional or statewide LCFS type program in Washington State, we are actually already filling those fleets with renewable natural gas, just to demonstrate that we are a good partner in environment and greenhouse gas emission reduction. So British Columbia, also, we have a fleet, and we've been fueling that presence and generating essentially an LCFS type credit. So I think probably by this time next year, we may see the entire West Coast covered by some kind of LCFS program. So where you are going to see RNG from anywhere in the U.S. or Canada fuel truck fleets or any kind of transportation demand is likely to be driven by these LCFS programs on the West Coast.
That's great. It's a great answer, Ryan. Thank you very, very much. Anybody else? Does anybody have a different view or anything to add to this question?
Yeah, one thing this is Nick at BP. One thing I'll mention is, it's nice as more buckets of low carbon credit opportunities come about. California is far and away the largest market. So we participate in the Oregon market as well. It is not nearly as sizable, and as far as access for renewable natural gas, outside of Waste Management's fleets, there's not a huge pocket of demand. But again, the more the merrier as far as LCFS for RNG, and as potentially the East Coast, there's opportunities there for additional demand as a result of regulatory programs. In Canada, some of the utilities got involved and have created demand. So whether or not it goes to transportation fuel, there's some opportunities in British Columbia to get a premium price for renewable natural gas. So again, it's the buckets are kind of all over the place, and the most streamlined, obviously, is if you can get very low CI renewable natural gas into California and participate with both the RFS and the LCFS. But we're seeing, I think, movement and momentum for additional markets to open up, which creates additional opportunities for renewable natural gas producers.
Right. That's very, very valid. And in fact, the RFS and the LCFS programs have independent processes that might impact the timing of dispensing when projects become operational. So would anybody like to give some insight into how do you guys manage that while also trying to generate revenue on a timely fashion? Perhaps Andy, do you want to give us your developer insight on this?
Hey, I'm sorry. Could you ask the question again?
Yes, of course. So I was saying that the RFS and the LCFS, they have independent processes when it comes to that the impact that they might have on the timing of dispensing when projects become operational. So how do you manage that, the timing issue, while also trying to generate new revenue in accordance to
it's a very important issue in the development of these projects that is often not fully appreciated until you're in the midst of it. Working capital on the front end of development is very important because there are time frames that are required to accrue and show injectability and storage of gas and dispensing and reporting and quarterly versus annual, where in which for the first 6 months to a year of operating an asset where you're putting gas in the pipe, you may not be generating revenues. And you have to account for that in your development and your investment side of the business. At the same time, the environmental commodities in the RINs and LCFS credits are merchant commodities that have price risk. And so the prices move up and down based on a very illiquid market basis. And so, for instance, credits under the RFS are trading at about a quarter of what they were at their peaks not so long ago. And so the credit values are going to move around. And so the investment type used in this market typically is a high risk, full equity basis. Debt is very difficult. I'm yet to find a debt scenario that actually works in the space because of those issues I've just outlined. We have started to see some waste bonding come in as far as financing the opportunities, but these projects are very capital intensive and they're very difficult to finance because unless you're financing off a balance sheet, which is what Waste Management has been very effective and able to do, and others, you have to find capital that appreciates that risk, and it can be very expensive in the process.
Hey, Diana, hi, Diana, Mike Kale. Maybe you can just add a little bit to what Andy was saying, that we work with developers to come up with basically a Gantt chart and walk them through their expected revenues. But what happens is the plant comes online, it produces the first delivery of gas. Essentially, as soon as that gas is tested, and then EPA submission is sent to the EPA. They have been really timely with approvals. They've kind of been in that 60-day range, and recently we just had a project get approved in 8 days. Once you have approval, then you go for what's called a QAP process, Quality Assurance Plan, and that's essentially allows your RINs to have what we call a QRIN status, and it makes them more marketable. People are more likely to buy them than just being from John's landfill per se, and that's a 30 to 60 day process. And then after that, you're able to dispense the product that you have either directly or out of storage, and then you're creating revenue within about 30 to 45 days after that part. And again, we put all that into a Gantt chart. LCFS is done concurrently to that. So typically you're going to look for 90 days of production and to look at how efficient your process is, the energy used to make that renewable natural gas. And then you'll have a score that the CARB, which is California Air Resources Board, would give you. So again, you can start working that into that same Gantt chart, and you can be dispensing in a quarter, sometimes it may be 2 quarters before you're dispensing. And that works both for helping understand downstream, but as well as upstream.
Which is wonderful. Thank you very much. Could you give any insight into how somebody can determine their potential score in advance of the final scoring that would happen through development and operations via the ARB or CARB?
Yeah, so ARB they have an ability, there's a process that you can go through. It's available on their website. We actually use a third-party consultant to do that for us. We feel that they're far more accurate and look at all the different positions that could be taken. But essentially, you're looking how efficient and past handling of that gas practice.
Wonderful. Thank you very much, Mike. That was really, really helpful. I'm going to start. I'm going to ask another question because I realize, some people are logging in again, and this is, a high-level question. It's very generic, and we can speak about it for hours. But if you would have to prioritize, and I'm asking this to all the panelists that are here today, what would you say are the main challenges, but also advantages of participating in the biogas or renewable natural gas sector?
Diana, Ryan here. I can lead off with that. I think the main challenges we are seeing right now on a federal level in the United States with the renewable fuel standard, there's been some volatility around the future of the program and the demand that the government sets for the following year, i.e. 2020, as well as who is exactly required to participate and who is not. So there is a portion of that program that allows the obligated parties, or typically refiners, to apply for essentially an exemption from their retroactive obligation to the program. So we have seen the number of applications either be sent to the government, be approved, increase dramatically in the last year. So that has caused volatility in the value of the RIN credit, which we then generate at a federal level off of the renewable natural gas that we put into our truck fleet. So I think that navigating the challenges and effectively forecasting how politics can actually affect the value of the renewable natural gas is definitely the largest challenge that I see on my desk. However, there are advantages in that the sustainability story is wonderful. So we have a sustainability group here at Waste Management, and one of the top priorities for them is the story of fueling our own truck fleet with renewable natural gas from our own landfills. So we call it a closed loop system. So the CNG truck that is running on natural gas going out collecting waste, is actually being filled by renewable natural gas from our own landfill that truck will then take the waste to later in that day. So the sustainability story is a wonderful advantage. I think that might even outweigh, in Waste Management's view, the challenges on the regulatory and pricing.
Yeah, that is true. Thank you very much, Ryan. And we do hear a lot about this nowadays. I think doing a lot in sustainability can definitely help with everything, both from a political, economical perspective and so on and so forth. Anybody else want to talk about a specific advantage or a really big challenge that they have ever since they've gotten involved in the sector?
This is Nick at BP. I can kind of build on what Ryan was saying, and as well as Andy and Mike on the regulatory side. I think obviously volatility in the regulatory markets is a big challenge, but some of the challenges I see in early discussions with potential developers are the assumptions that are made on what a CI is going to be and when a project is going to be online. And in the eyes of the regulations, not all biogas is the same. Under the RFS, you can end up as a D3 RIN or a D5 RIN based on your feedstock and how the regs are written. Under LCFS, you have a much broader spectrum, obviously, and Andy had talked about it earlier on the call, where, a landfill could be a plus 50 CI, and, an AD facility that's taking dairy manure might be a minus 250 CI. But because it might be, it doesn't mean that everyone that's got access to dairy waste should be assuming a minus 250 CI for their project, and furthermore, assuming that their economics are going to be driven by that number. That number is critical, and having an early look from a third party to come in and do an evaluation of CI is a major step that needs to be considered if you're developing these sites, because you will end up somewhere in the spectrum, and just because there's a project with a minus 250 CI doesn't mean that every dairy AD site will have that. And obviously, if you're generating your revenues from a CI score and a credit price, effectively, it's huge. And understanding what the current manure practices are, and none of those things can be understated as you start looking at these projects. And I say that because I've been approached about, big negative CI numbers, and which is really what's going to dictate what ends up in California. Is the lowest carbon intensity will ultimately win the day. So having a very clear understanding of that is important, but remains, I think, a big challenge that shouldn't be, that, let's put it this way, should be heavily considered.
Yeah, I would add to that point a couple of things that are important to consider. We at AMP developed and brought the first dairy project into California, and it scored a negative 255 on the CI scale. And so almost everybody that is developing their first project tends to use that number in their pro forma. And simply moving that number up and down 20% has a drastic effect on the revenues of their project. And each farm if you do a cluster of farms in that case, or each facility that produces gas goes through its own CI analysis. And so we ourselves are working through a number of projects, and we have CI scores on our project that can range anywhere from negative 150 up to negative 300 plus. And so it's a very sensitive analysis. It's a very important analysis, and as somebody developing a project, I think it's probably the most important thing that they think through. And there are consultants out there that can help you, and there are resources on the websites to look at that. But sometimes that's taken for granted, and I think that's probably most important. The other thing is that these are operating assets, and so things are going to break. Temperatures are going to affect things. Feed on, biogas quality is going to change. Pumps are going to break. Temperatures are going to affect your ability to inject gas, and so uptime is often a component of performance and analyses that is a forgotten thought. And things break, and things need to be replaced, and having appropriate allocations of capital for managing those aspects and managing and producing the best gas you can. A landfill, how you manage the blowers on the system will affect your oxygen and nitrogen content, and your siloxane content will affect your gas quality. And in a digester, how manure is fed at what total solid content is going to affect your gas quality. And ambient temperature will affect you. When it's hot out, cows don't eat as much. When they don't eat as much, they don't defecate as much. So all those things need to be taken into account in correctly looking at the economics of these deals. So on top of that, the merchant risk and the price risk associated with the commodities just makes this a difficult space to develop projects.
This is Mike, and I would add one additional component is the challenges we see, and it was touched on in the capital discussion earlier, but it's the liquidity of the markets. So in the RFS, you have the RIN market, and the RIN market really doesn't trade forward at all. So you're going to trade in a 2019. You might trade 12 months if you're doing it in January, but we sit here on August 1st. We don't see a market in 2020, and that's 5 months away. So in the LCFS market, we have been fortunate enough to do some forward hedges out to 2021, but it's a very thin market. There's a very few players, and then in the RIN market, again, it's just there's no level of depth And that adds to the uncertainty. It makes projects hard to finance. We worked with companies to give them a fixed price or a floor price, but it makes it difficult for us to go out and do that as well because there is no forward market. I think people talk about pro formas and they stick in, $195 or $200 in for a credit price, but it's important to remember that LCFS credit prices, a year and a half ago were $100 or less. And Andy mentioned before that, RIN prices are about a quarter or less than of what they were 18 months ago. We were at $3 RINs and today we're at 65-cent RINs. Just to give a perspective.
Yeah, so that's a really good point because that raises a lot of concern. I think a lot of people are wondering whether the new RIN prices are actually the new norm, or is that something that is expected to change back to the prior levels, or do you think it should?
This is Andy.
Yeah.
To talk to that point, Diana. Yesterday, I testified in front of the EPA about RFS and the RVOs, or the requirements that they throw to the market. And they use various mechanisms to determine RVO numbers. And RVOs basically dictate the demand for RINs in the market. And depending on if that's a low number or a high number, it affects price. And the challenge we have is they are becoming increasingly conservative in the allocation of RVOs or setting the targets for RVOs. And so it has a ripple effect down to projects because we're seeing two things happen. One is we're seeing supply and demand have a huge effect on price, but we're also seeing the EPA at a very arbitrarily led basis providing exemptions to small refineries. Basically, there's a hardship ability for a refinery to say that this is causing angst on their economics, and they can ask for their RIN requirement to be wiped away. And they've given out record numbers of those, originally led by Pruitt and continued through the existing administration. And what that does is it continues to erode the demand, and so that's one of the big leading causes that we've seen in the price disparity. And so uncertainty in that market is both led by liquidity but also led by the policy and the politics. And so those are big challenges that we have on a going forward basis.
That's a very, very valid point. Anybody want to add to that? Any concerns regarding how RIN prices are changing, whether that affects the process of underwriting new renewable natural gas projects?
Diana, this is Ryan. I know that from our 250 approximately landfills that we own and operate, we have taken an analysis and looking and discovered that RNG facilities may work on some of them due to high gas quality and not others due to low gas quality or some other reasons. But I think that pipeline injection distance, so how far you actually have to build a pipeline from the landfill to the injection point the utility owns and operates, can be a deciding factor. So at a 65-cent RIN, a landfill RNG project that might have had to build a 5 to 10 mile pipeline might not look so attractive as it might have at let's say $1 or $1.50 RIN. So that's definitely something that my team is looking at, and I think that the projects that might have been challenged at $1 RIN, are either on pause just due to that distance maybe to a pipeline from that landfill. So I'm sure that maybe some of the other gentlemen on the call have seen that as well, that the number of possible projects they might be starting either this year or next year, maybe on pause for a bit until there's some regulatory and price certainty in the federal RFS market.
The three other points I would add to the points that Ryan making, they're very good points, is the cost of interconnect. You can see a cost of interconnect range from $500,000 to, we've been quoted some over $5 million. And you'll also see different gas spec requirements that we've had some that have crazy oxygen requirements that require different technologies. And then the last is you also have to discuss and deal with right-of-way issues and bringing that gas either to that interconnect or getting the utility to come to you. And so those are all additional things that need to get addressed. And so it's every project is unique, which is one of the challenges in the space. Every project has its own challenges and situations. Finding the perfect scenario sitting on top of a pipe that's going to cost $500,000 and has a flexible spec, there's not a lot of those. And so those are other big challenges to look at in finding these projects.
Yeah, that is yeah, I appreciate your answers. They're all very, very valid. I'll go back to a initial point in production at the beginning of the production cycle. So we see a lot of legislation now, a lot of different laws looking to ban the disposal of organics to landfill. There is one in New York State, for example, that is looking to do that after 2021. And in general, different states have different ways of approaching it. But this type of laws, they offer the redirection of organic food waste to anaerobic digesters, right? So that could potentially be a possibility to make more renewable natural gas that can then be used to fuel trucks and potentially create reliable monetary value. Do you think that is the case, or do you disagree that it would create more monetary value? Would anybody
Diana,
like to,
as the landfill guy, I guess you could say on the call, we've seen that in California a bit, and I think that the goals that the state regulatory bodies might propose are very lofty and might be difficult to achieve because you will need to adjust the behavior of the individual, i.e. the homeowner or the resident or the commercial business that you are then picking up the waste from, who would then need to divert something that they might have just formerly thrown into the trash. So there is an opportunity there for that digester gas. Depending on the feedstock, you may create something called a D5 RIN, which is historically been valued much less than the D3 RIN, which comes from a landfill project or a agricultural biogas project. However, it may have an actual lower carbon intensity score. So we've seen refineries on the West Coast very interested in actually taking renewable natural gas from these type of anaerobic digester food waste projects into the refinery as a process fuel, which then might create a renewable gasoline or a renewable diesel, which would then generate an LCFS credit. So that program, it's the renewable hydrogen, or there's some others in California that CARB will allow. That really hasn't taken off. There hasn't been any credit generation there because of the value of the D3 RIN being so high historically. But now that the D5 RIN, which is again resultant from that separated food waste anaerobic digester, is almost actually at parity with the D3 RIN. So if we see the market continue as it is, I think you might see some more interest from renewable natural gas developers to potentially diversify where they are sending their gas and actually being supportive of those diversion policies that states may implement.
right. So in a way, are you saying that this might also create new possibilities of demands? For example, more renewable natural gas demand on the East Coast, let's say?
I think it would depend kind of on a few things. You have to think that waste would have gone to a landfill anyways, and if there was an RNG facility located at that landfill, over time it'll still be anaerobically digested in the landfill. So you're just essentially removing it and creating a different market for gas that might have a better placement outside of the transportation fuel market on the West Coast, but on the East Coast there haven't been any kind of LCFS type programs implemented yet. So I would think that, as a developer, we would probably still place that into the landfill if there's no regulation.
Understood. In general, what do you think would make the, both D3 and D5 RINs prices, what do you think these prices should actually be to make these projects more attractive for investors? If you were an investor, what do you think would be reasonable?
That's going to be a tricky question, just due to the size and scale of the production facilities. That's a tough question to answer because, again, none of these two projects, no two are alike or identical. So, and your access to the low carbon markets are going to drive that. So I think that's something that really needs to get evaluated on a case-by-case basis. To back up and answer your question about what keeping organics out of the landfill will do, and I think ultimately if there's attention put on the organics and the opportunities there to produce renewable natural gas, which is a long-term low-carbon fuel, if you look at the broader narrative outside of just RFS and LCFS programs, things tend to be moving in a direction where demand will be and continue to be created at a premium. What that premium is, obviously, is the billion-dollar question. But, there are corporations that have put out, premium pricing for RNG. Utilities have started to make moves that direction. Obviously, the transportation piece is the most valuable. But long-term, having a low-carbon fuel-producing asset, I think there's a lot of potential and should be a lot of excitement around that. And being able to, separate the waste creates very direct opportunities, I think. Obviously, the pipelines give you access to broader markets. That's the beauty with RNG. It can be used, to produce power on site. It can be used as a fuel for transportation fuel, or they can use it as, you can convert it over to hydrogen and do some other creative things with it. So the versatility of RNG alone, I think, sets it apart from some other renewable fuel assets. RNG right now is a blip if you compare it to the amount of conventional natural gas that trades through the pipelines in North America. So just getting additional exposure to the marketplace, I think, should help drive investment as well.
I think further to Nick's point, the biggest thing is we need more demand. We need more incentive programs. We've been recently in California trying to fight where they're trying to roll back some of the programs. We need more trucks because the supply of gas is growing faster than the demand. We're starting to see some entities look at corporate social responsibility and wanting to incorporate RNG into buildings and other areas to cut carbon. There has to be a willingness to pay the higher price comparatively, but I think what's imperative to our business is demand and trying to help entities get comfortable with the technology and trying to get new technologies. We need better engines, we need new engine technologies, and we need better adoption of the technologies, because when you compare CNG, right now the sexiest avenue for trucking is electric. But when you look at the emissions profile, where that electricity is generated, RNG is still the cleanest fuel across the board on all emissions profiles. And that needs to be pushed and not forgotten. So we get back into the realm of being the sexiest fuel, because right now electric is pushing us in that area.
That is great. I think that's a very really forward-thinking note to wrap up this webinar on. I wouldn't do this normally, but we are reaching the maximum time that we can be on the platform for. So the recording is only available if we do the webinar for 60 minutes. So I think this is a good time to wrap up. So I'd like to thank everybody who got involved. Obviously BP, US Gain, AMP Americas, and Waste Management especially for making this a really big success. I think we covered quite a lot of things. Just to give you a spectrum, we've had more than 800 of you around the world joining us today. So hopefully you guys gained even more than what you hoped from our great speaker lineup. Again, before anybody asks, all the recordings will be sent to you via email. And where do we go from here? We know from this webinar that there are actually things that we can do to monetize renewable natural gas production for the vehicle fuel market, even if there are a lot of challenges to take into consideration. We will be covering relevant stories at New Energy Update. You can subscribe to our newsletter via our website. We are always open for collaboration for future webinars, white papers, reports. If you want to contact me, you can do that directly using the details on the screen. And until then, thank you all for tuning in, and I hope you have a wonderful day.